Good morning. This is Mauricio Orozco with Tax Associates Tax Tips. Today we're going to be talking about the new QBI, Qualified Business Income Deduction. Close up on the new QBI deductions wage limit. The Tax Cuts and Jobs Act provides a valuable new tax break to non-corporate owners of pass-through entities, a deduction for a portion of qualified business income, QBI. The deduction generally applies to income from sole proprietorships, partnerships, S-corps, and LLCs. It can equal as much as 20% of QBI. But once taxable income exceeds $315,000 for married couples or $157,000 for singles, the QBI begins to phase out. Full versus partial phase-in. When the wage limit is fully phased in at $450,000 for joint filers and $207,500 for other filers, the QBI deduction generally cannot exceed the greater of the owner's share of 50% of the amount of W-2 wages paid to employees during the tax year, or the sum of 25% of W-2 wages plus 2.5% of the cost of qualified business property, QBP. When the wage limit applies but isn't yet fully phased in, the amount of the limit is reduced and the final deduction is calculated as follows. 1. The difference between taxable income and the applicable threshold is divided by $100,000 for joint filers and $50,000 for other filers. 2. The resulting percentage is multiplied by the difference between the gross deduction and the fully wage limit deduction. 3. The result is subtracted from the gross deduction to determine the final deduction. Some examples. Let's say Chris and Leslie have taxable income of $600,000. This includes $300,000 of QBI from Chris's pass-through business, which pays $100,000 in wages and has $200,000 of QBP. The gross deduction would be $60,000, which is 20% of $300,000. But the wage limit applies in full because the married couple's taxable income exceeds the $415,000 top of the phase-in range for joint filers. Computing the deduction is fairly straightforward in this situation. The first option for the wage limit calculation is $50,000, which is 50% of $100,000. The second option is $30,000, which is 25% of $100,000 plus 2.5% of $200,000. So the wage limit and the deduction is $50,000. What if Chris and Leslie's taxable income falls within the phase-in range? The calculation is a bit more complicated. Let's say their taxable income is $400,000. The full wage limit is still $50,000, but only 85% of the full limit applies. And this is $400,000 taxable income minus the $350,000 threshold divided by $100,000 gives us 85%. To calculate the amount of the deduction, the couple must first calculate 85% of the difference between the gross deduction of $60,000 and the fully wage limited deduction of $50,000. And the calculation is $60,000 minus $50,000 times 85%, which gives us $8,500. The amount is subtracted from the $60,000 gross deduction for a final deduction of $51,500. But that's not all. Be aware that another restriction may apply. For income from specified service businesses, the QBI deduction is reduced if an owner's taxable income falls within the applicable income range and eliminated if income exceeds it. Please contact us to learn whether your business is a specified service business or if you have other questions about the QBI deduction.